Hi, my name is Jason Martin at AllGen Financial Advisors, and in this video, I'm going to show you how you could have a diversified portfolio while at the same time minimizing taxes as much as possible. And this could potentially save you a ton of money on taxes over the long term. And what is it? It's direct indexing. So over the next 10 minutes, I'm going to walk you through in plain English what it means to participate in a direct indexing portfolio and who could benefit the most from it. All right, well, let's start first by looking through who should consider a direct indexing portfolio. So here's some scenarios where it may make a lot of sense for your financial situation. For one, if you had a concentrated position that has a very low cost basis. So let's say you've had one individual stock for a long time. It's got a really low cost basis. You're taking a lot of single stock risk by owning that, but at the same time, you don't want to sell it because it's going to cause you a lot of taxes. This could be the ideal scenario for having a direct indexing portfolio, and I'll explain why later. Or if you anticipate a large taxable event in the future, like maybe you're planning on selling your business one day and that's going to generate a huge capital gain, or you have investment properties that are going to be sold in the future, and that could generate a large capital gain. So those are other potential reasons why it could make a lot of sense to have a direct indexing portfolio. And at the same time, if you're just in a high tax bracket, it could make sense to have this type of portfolio, as you could potentially reduce your taxes on any given year. All right, so if all three of those boxes are checked, it's even more of a great potential opportunity to consider. So if we're looking at what actually is tax loss harvesting? So in order to understand the power of direct indexing, you have to understand tax loss harvesting. Tax loss harvesting means intentionally selling investments to realize a loss in order to offset realized capital gains. And in some cases, a limited amount of you'll be able to reduce your ordinary income by a limited amount each year. So it's important because it can lower your tax bill and keep more of your money compounding as opposed to it going to paying taxes. And then excess losses, if this strategy was able to create more losses than you can offset in gains in any particular year, it can carry forward indefinitely. As of the recording of this video, the IRS allows you to carry your losses forward indefinitely, essentially creating a bank of losses to offset future gains. So when done thoughtfully within IRS rules, avoiding wash sales, it turns market pullbacks into opportunities to improve your long-term after-tax returns. All right, so if we were to look at okay, so now what is direct indexing? So imagine you hold an index portfolio where you have like the S&P 500, you have an ETF for the S&P 500, or you have an ETF for the Russell 2000, and you build your portfolio based off of ETFs. So in that portfolio, it would just hold the ETFs, but you would have exposure to all the stocks within those ETFs. So direct indexing is where you hold the stocks in that index directly. So basically, you're getting a similar index, but instead of holding the ETF, you're holding all the stocks that make up the index. Okay, so mechanically, like how does it work for you to be able to capture losses in this direct indexing strategy? Well, I'm going to give you a simple example of Home Depot and Lowe's. So Home Depot and Lowe's, let's just say the S&P 500, it holds Home Depot and Lowe's, which it does. And those stocks are very highly correlated, which means they go up and down at the same time, as you can see with this chart of both of them here. But on any given year, you may have that Home Depot and Lowe's may be down. So let's say I still want to keep exposure in those areas because they could rebound, but I want to take a loss for tax purposes. So the strategy could sell Home Depot, let's say, when it's down about 12%, and you would therefore realize a capital loss that you can use for offsetting gains. But at the same time, it could buy a little bit of Lowe's. And that way you maintain your same exposure in the portfolio, but at the same time, you've also captured a loss. Thereby not deviating much from the index's total returns over time. That's called a tracking error. So the reason why this is such a powerful tool is because if you had like the S&P 500 and the Russell 2000 and just held the ETFs, if you go through a strong market, all of those positions are up and they have unrealized gains. There's no potential to capture unrealized losses. But like if you look at a normal index on any given year, about 30% of those stocks experience a negative return at some point in the year. And so if you imagine having the Russell 3000, which has 3,000 stocks, 30% of them are down at any point during any given year. That's 900 stocks that are potentially down to be able to capture losses with. It opens up the opportunity for loss capture much more so than holding the index directly. All right, so let's compare. So some people may ask, like, well, can I do tax loss harvesting with ETFs or mutual funds? Yes, you can, but if you compare direct indexing with ETFs and mutual funds, you'll see that direct indexing holds a lot more advantages. And by the way, when we manage our clients' portfolios, we are doing tax loss harvesting within ETF portfolios. But as you'll see here, this strategy offers more opportunities. So you still get the same level of broad diversification with direct indexing as you would with ETFs or mutual fund. The tracking error is slightly lower than ETFs and mutual funds, which means it's not going to be as close to replicating the underlying index or the S&P 500, but it's still pretty close. The tax efficiency is very high for direct indexing. So there's a lot more tax loss harvesting opportunities, and all losses are available to investors for offsetting gains. ETFs are tax efficient because the capital gains aren't passed through most of the times, but at the same time, the net losses are not distributed. And then mutual funds are the least tax efficient. They have capital gains passed through to shareholders, and net losses are not distributed. So from a tax loss harvesting opportunity, this is where direct indexing really sets it apart compared to ETFs and mutual funds. There's so many more opportunities just because of all of the underlying holdings. There's fewer opportunities with ETFs and mutual funds. And if you do direct indexing through AllGen, we have found a way to do it in a very cost-effective way, where it's essentially the same that you would pay from the fund fees of an ETF. Mutual funds a lot of times are the least cost-effective and have the highest fees. They're relatively low for index funds, but for any other funds, they're much higher than ETFs are, and direct indexing is the way that AllGen does it. All right, so there's a study done by Vanguard so you can see kind of why it makes a difference to do this type of portfolio. And if you want to, you can certainly read through all these, pause the video and read through all these, but essentially it's taking, the study's taking $1 million portfolio, and it looks at how much in losses was it able to capture over a 10-year period. Each one of these bars represents a 10-year period. So if we're looking at 2009, that's 1999 through 2009. If we're looking at 2024, that's 2014 through 2024. So if you look back over those last 10-year periods, how much in losses was the portfolio able to take? And as you can see here, in a really bad market environment like 2009, it was able to capture a $1 million portfolio, was able to capture $800,000 in losses, while still tracking essentially the same as the index. And what that means is, if you think about $800,000 times your capital gain tax rate and the savings you can get by multiplying those two, that's a lot of tax potential savings over time, which means you can allow more of your money to compound and less of your money has to go towards paying taxes. And even in a strong market years like 2014 to 2024, still able to generate $400,000 in losses when the portfolio compounded up and had good returns, just like the underlying indexes did, like the S&P 500, for example. So you can start to see the power of this. And when you take it from not just a dollar standpoint, but a percentage standpoint, if you did not liquidate the portfolio and you held on to it from the standpoint of what is the after-tax additional return, sometimes called the tax alpha, after-tax additional return of the portfolio during any 10-year time period. Obviously, when you're able to capture a lot more losses, that reduces your taxes more. That generates a higher after-tax annualized improvement. So in this Vanguard study, you can see that in a really bad time period like 2009, you had almost like a 2.4% additional annualized greater return each year from an after-tax perspective. And even when markets were really strong, it was still close to a 1% after-tax alpha every single year. That's annualized every year. This is how it would work if you were to have a portfolio with us that has direct indexing. The direct indexing only takes effect in the stock side of your portfolio. You can still maintain the same AllGen tactical allocation with your bond side of your portfolio, with the commodities or alternative side of the portfolio, but with the stock side of the portfolio, that's in the direct indexing approach. So as you can see in an aggressive portfolio, the dark blue would be the U.S. stocks, the light blue would be the international, and all of that would be direct indexing, whereas you would have your bonds and commodities still the same as it would be in a normal AllGen portfolio. And we can always be tactical in terms of total amount of stocks and total amount of bonds, but only the stock side would be invested in a direct indexing portfolio. Moderately aggressive and balanced, you can see down the conservative hold a little bit less than direct indexing and more in the AllGen bond and commodity portfolio. So depending on your risk profile, this is from a 25,000 foot level, how it would look like for your portfolios. So all that to say, I hope this was helpful in terms of understanding what direct indexing is. This, like I mentioned in one of the first slides, there are some ideal scenarios that this could work really well for. And if you believe that you are an ideal fit for this type of strategy, feel free to reach out to your advisor here at AllGen, and we'd be happy to explain it and look and see if this would make the most sense for you. All right, thanks. Take care.